And so to the $1.9 trillion coronavirus stimulus package that's gone through US Congress this afternoon in Washington, which is Joe Biden's plan to rescue not just his country, but if the Organization for Economic Cooperation and Development are right, could actually kickstart a global recovery and add 1 percentage point to global growth. President Biden expected to make a televised address in the States now that this package has been approved. So tonight, we wanted to ask the question, how will this work? How does one stimulus package in America trigger a global recovery? And what might it mean for you and for your wealth and for your prosperity and your job security? So we've assembled some of the finest brains we could find for you, way bigger than mine, who understand this kind of thing and hopefully can explain it to you in clear English. Vicky Price, economist and former joint head of the UK's Government Economic Service. I can't thank you enough, Vicky. We always come to you on the tough jobs and you never say no, and I'm really grateful to you.
Not at all. Thank you for asking me.
Peter Earle we'll speak to in a moment, research fellow and economist at the American Institute for Economic Research. And I think Liz Landers is up and ready to go as well, political correspondent for Vice News in Washington, D.C. Hi, Liz.
Hi, thanks for having me.
Nice to connect with you again after all of the Capitol Hill stuff. That was the last time that we spoke to you on this programme, wasn't it? And are we now hoping for calmer times? And give us some of the details of this stimulus package and a direct handout to every American, I understand.
Yes, it's definitely calmer times here in DC. And I was actually reflecting on this today and thinking about how it's much more focused on Capitol Hill now, kind of the craziness, instead of the White House. And the negotiations around this bill have been, going on basically since before President Biden came into office. And we've seen him, he stated at the beginning, around Inauguration Day, what he wanted in this bill. And they wanted to extend these stimulus checks. So that's probably the biggest benefit that Americans will get. So that will mean another $1,400 check that Americans will receive. There is also an extension of jobless benefits. That was something else that Biden and his team wanted. There's more money in there for states, for municipalities, so that they can better roll out this vaccine that the U.S. has now gotten more doses of. So there's a lot in there for the American people. And because of that, this is pretty popular in the U.S. About 75% of Americans like this bill. So that means that there are Republicans in this country who like this bill too, even though today we saw that vote in the House did not have any Republicans that voted for it.
My next question we will put properly to an economist, so don't panic, because I know you're a political correspondent, not an economist. But if you've got a clue on where this money comes from and what kind of debt it saddles with the United States with, then offer us a thought on that, because it's $1.9 trillion.
Right. It's a huge amount of money. And that's actually the main concern that Republicans have brought up. And that is what I've heard on Capitol Hill from most of the people that voted against this is, where's this money coming from? And how long will it take us to get out of, our national debt if we keep spending like this? I believe that this money is going to come, I think in some way, shape or form from taxes. So that is, obviously not super popular here in the U.S. But that's basically the main reason why Republicans voted against this, because a lot of them believe that this bill is too large and not targeted enough.
Okay, Vicky Price, there's your starter for 10. Where'd you find 1.9 trillion from? Last time I looked down the back of the sofa, I couldn't find a quid, never mind 1.9 trillion.
Well, you issue bonds, of course. You sell those bonds to the market, and somebody's going to buy them and basically lend you the money. And then you've got the Federal Reserve Bank behind it, which is going to buy those bonds if anyone wants to sell them in the secondary market and keep interest rates relatively low, so you don't have to pay an awful lot for it. At some point, one guesses that some of that will be retrieved by higher taxes, but that isn't going to happen in the short term. So for the moment, they can carry on borrowing, and it is a very substantial extra stimulus to the economy. It's something like 8% of GDP going into it. It has already, of course, seen, the US has seen other stimulus packages. So this is, I think, the third big package that's been introduced. And of course, individuals in the US have done rather well in terms of getting that money through checks or unemployment benefits. But there's one point to make, that it is slightly different to what's been going on here. We've also been putting an awful lot of money into the economy, or in Europe, where we've had furlough schemes. So people have been kept on jobs through ways which have managed to keep you on payrolls, with money being given via the companies that you work for, and therefore unemployment has stayed quite low. In the US, they didn't do that at all. So they just let people lose their jobs, and unemployment rose very, very substantially. So loads of people on unemployment benefit right now, benefiting themselves from that extra increase in what they get every week.
And allow me to take you back to what you said at the very beginning then. So bonds are issued. Who buys a US government bond? What kind of organisation or person buys one of those? And then what does that bond mean to you? What's its value?
Okay, well, those are fixed interest bonds usually. So basically, it means that you're issuing a bond and you're saying, let's say, I want to borrow $100 off you. I'm going to be paying you a fixed interest of, $1 a year. Then investors come and buy that. Those investors could be pension funds. It could be even, financial institutions, other financial institutions, banks, and so on that come and buy those. So they're guaranteed in the sense of having a fixed return, and therefore you're quite safe about acquiring those bonds. And also, normal investors who would go and buy shares may decide to buy bonds, and loads of people do that as well. So they can switch from one to the other quite frequently. They can be foreign institutions. In the US, of course, what they've seen is that China buys quite a lot of US debt. So foreign countries, foreign governments come in and buy those bonds as well. And that is basically how you do. So you say, right, in 10 years' time, this bonds lasts, say, for 10 years, I will be redeeming all those. So you lend me money for 10 years. So in 10 years' time, I may decide to either, I will pay it back and then maybe issue more bonds to replace that. So you don't necessarily have to pay that debt back ever, if you see what I mean, because you can always, assuming the markets are prepared to lend it to you, issue more debt at some point.
So there's no reality at all that Joe Biden will be expected to clear this $1.9 trillion worth of debt in his presidency?
No. In fact, debt is increasing every year because unless you move into a yearly budget surplus, in other words, what you receive from taxes is higher than what you pay out to unemployment benefit, let's say, or for the pandemic relief, for example. So your health service or anything else you do, your infrastructure spending, and so on. So you normally collect less than you actually spend year after year. It's very, very rare for a government to have a surplus on its annual budgetary cycle. So what they do is they basically add to their debt. But what may happen if we get growth in the US, which is actually what the OECD, the Organization for Economic Cooperation and Development, you mentioned before, that APTI's forecast is expecting for the US, is that they will grow very substantially next year and probably again the year after. So your debt to GDP ratio goes down. And that way the markets think, well, you're doing something right. So they will continue to be prepared to buy your debt. And if you have the Federal Reserve behind you, then you're guaranteed there will be a purchaser if you decide as a financial institution buying that debt to sell it to somebody, because they'll be ready to do so and offer you a good price for it.
Got it. Okay. Pete Earle joins the discussion, research fellow and economist at the American Institute for Economic Research. Evening, Pete. So Vicky's just explained there how it works. What about the size of this stimulus package, the $1.9 trillion? Is there any concern in America about that? Or is there an understanding along the lines Vicky's just explained where governments never really clear their decks and they just keep adding to the debt?
It is true that governments often roll their debt over, and in some cases there's sort of an implicit understanding that the other side, whether it's China or Russia in the case of U.S. Treasuries, won't cash in. But it's not all just debt issuance, and partially because we've had some issues lately where it seems like certain foreign buyers, whether it's because of geopolitical tensions or whether it's just because of risk appetites, are not as willing to buy U.S. debt as previously. We've had some hiccups in the lending markets for treasuries. They're called repo markets. And so to some extent, I do think it will be bond issuance, but we also have two other things. You have, of course, taxation, and you have printing of money. And so first of all, it's important to remember that government doesn't essentially have money of its own, right? It has to either tax people, it can print money, or it can issue debt. And each one of those comes with other costs. There's no free lunch. So when you print money, when the government prints money, whether it's because it directly purchases treasuries or it does other financial programs, monetary policy programs, you can oftentimes have inflation, and you can have changes in relative prices. You have what are called Cantillon effects and distortions, and those affect how businesses can function. With debt issuance, at times you find that you have lower growth, and sometimes you have decreased creditworthiness. And with taxes, of course, you're talking about redistribution. So while we may see the kind of growth that's predicted, I believe it said 1%, it's important to remember that the last time, and this stimulus, this COVID relief bill is not the same as the others, but the previous time we had one, we actually saw individual personal spending fall. And the reason why is because with lockdowns going on, with other uncertainty, most individuals who received that $600 stimulus chose to basically pocket it and not spend. And when you look closely at the huge growth in the American GDP, the recovery last fall, 40% of it came from federal non-defense spending. That's government spending. So I think we should be very cautious about how we praise these measures, lest they become commonplace.
Yeah, and just let me pick up on that thread with you, Pete, about this 1% prediction from the OECD then. Can you explain to our listeners how one stimulus package from America can trigger a percentage point around the world? What's the theory behind that?
Oh, sure. So there are a couple of mechanisms. I think the most prominent one is that the U.S. Is one of the largest, has some of the most expansive trading relationships in the world. We have the largest GDP. So, what happens here tends to find its way into trade, and our exports or other countries rather imports, and many U.S. companies are multinationals, and the dollar remains the reserve currency of the world. So there are all sorts of transmission mechanisms through which American growth translates to growth elsewhere in the world.
Vicky, what about you on that and on the OECD prediction? How confident are you that it will add a percentage point to global growth?
Well, the truth is we're not confident of any predictions right now. And I think the OECD itself is saying that there are lots of downside scenarios. And one of the main concerns that it has is that some of the other countries' stimulus packages aren't going to be anything like as big, because it's relying on the rest of the world to do things as well. But remember, it was already forecasting about 4.5% growth for this year for the world economy. And obviously the US is very, very significant in this, but it's not the only player in the market. I mean, China has done very well too, and it has been importing quite a lot of goods from, say, Germany. So one of the reasons why at least German manufacturing and exports have remained quite high, and there is still hope for Europe as a whole, is because of Chinese demand. And hopefully, of course, if there is some agreement between the EU and the US on the trade relationship, because already there's been some easing of the problems that we had under Trump, that will also help growth. But obviously, if there is more demand from the US, it's going to help everybody. The export way of encouraging growth and trade more generally is the surest way of having faster growth in the world economy. So the OECD is right to say that if the US does better, then the world does better, but much depends on what the rest of the world does too.
Yeah. And Peter, let me come back to you on this stimulus package, which I'm now reading is the second largest economic stimulus bill in US history. How do you control inflation with a stimulus package this large? Janet Yellen doesn't seem to think it'll be a problem, the US Treasury Secretary, but if inflation spirals, it will be a problem, won't it?
It will. And the thing is that we have an economy now where we've spent the better part of a decade and a half with interest rates under, say, 3%. And so you have a lot of businesses, a lot of enterprises, a lot of personal borrowers who are used to rates being this low. If we had a sudden breakout of inflation, even something, not hyper, but let's say runaway inflation, galloping inflation as it's called, the Fed would be forced to raise interest rates. And right now, it was one thing to raise interest rates when we were in the neighborhood of, say, 3 to 8%, 6 to 8%. But with so many enterprises and so many institutions, so many individuals having their entire capital structure predicated on rates below, say, 3%, raising of interest rates would I think have, it would probably ring out the inflation, but I think it would have a devastating effect, more so than if we had been at normal rates and maybe let the previous recessions and corrections work themselves out.
So, Vicky, just finally, in a big picture sense, what are the key indicators that you would look at for economic recovery. This stimulus package is obviously one of them. The speed of the vaccination effort, I'm guessing, would be another. What else?
Absolutely, and also the speed with which countries start opening up. I mean, we've been hearing a little bit about various countries now about to allow, tourism to start again. But really, it's deeper than that. It's trade relationships really improving. People able to move between borders, and feeling, of course, that you can once again socialize in a way. So there are huge areas of the economy which have been shut really for quite some time. So hospitality, tourism, but the service sector more generally, where a number of the sort of more advanced economies, depend for growth. That has been affected very significantly. Manufacturing is done fine, construction has recovered in various places, but overall services have been quite negatively affected, and the consumer hasn't gone out to spend to the extent that they would before. So you'll be looking at all that. You'll be looking at consumer confidence, and you could also be looking at business confidence. Do they start investing again? And again, I think it will vary from place to place. We're probably going to come out of it in a very uneven way. And a lot of it actually, strangely, will depend on the types, or will be correlated to the types of stimulus packages that different parts of the world have had.
Liz Landers, final thought from you as political correspondent for Vice News in Washington. I'm told Joe Biden will address the American nation now this has gone through Congress. Is that going to be tonight or tomorrow night?
He's going to address the public on Thursday, so tomorrow night. But he's actually, interestingly, not signing this bill into law until Friday. I think we need to ask the White House why that is, because a lot of people are waiting for these checks. And the faster this becomes law, the faster people start getting the benefits of this. But yeah, he's supposed to address the American public tomorrow, and it will be a year since the U.S. has really shut down. And so I think he's going to be focused on this and touting the fact that this bill just got passed, and it's a huge spending bill that Democrats think is really going to help the American public.
And how much is each adult getting?
What's that? Sorry, how much his speech?
Yeah, the amount of money that's going to each adult in the States. The direct
It'll be
cash.
14. Right. So that direct stimulus payment will be $1,400. That's the top payment. So between that and what was passed at the end of last year, that $600 payment, that's $2,000 that Americans have gotten in the past few months.
Yeah, wow. Okay, Liz, nice to have your company again. Liz Landers from Vice News, political correspondent based in Washington, D.C. And my sincere thanks as well to Pete Earle, research fellow and economist at the American Institute for Economic Research, and Vicky Price, economist and former joint head of the UK's Government Economic Service, who always does a brilliant job for us on this programme, and we're very grateful to her.